This video is for general information and educational purposes only and does not constitute financial advice or a recommendation. It does not consider your personal financial situation, objectives, or needs. Past performance of investments, funds, or insurance products and any market projections are not indicative of future results. Please consult a licensed financial advisor before making any financial decisions. Welcome back to Coffee, Tea, Money Talk. Today, we're going to talk about the low-risk route for retirement planning. So, you are planning to retire. How do you actually plan for it? Just save money in the bank and wait for retirement, where you can draw it down to supplement your CPF life payments? What else?
Keeping money in a bank savings account may not always keep pace with inflation, so it's important to consider other options.
So, what else is available to supplement our retirement income?
Quite morbid, but yes, fill up your war chest and then start to empty it when you need it.
Good. Anything more advanced?
I think it would be good if, while emptying the container, it is also nice to be able to put more water into the tank, so that the amount of water doesn't just get lesser and lesser. For example, some people may receive rental income from property, which can supplement their retirement funds. Of course, this depends on individual circumstances and market conditions.
Yes, and I think some people may hold shares or funds that pay dividends, which can provide as an additional source of income and also help to fill up the container, though returns are not guaranteed.
Investment has risk, of course. And will that be the best move?
Risk is definitely there, but if someone is comfortable with it, investments can be part of the plan. It's important to match choices to your own risk appetite.
There's also fixed deposits, T-bills, Singapore savings bond. But the interest fluctuates and it's a little hard to plan for the long term, especially fixed deposits and T-bills. Singapore savings bond rates are already published, so you can somewhat plan.
Insurance-based annuity plans are another option. You contribute during your working years, and at retirement, they provide regular payouts. The structure and benefits vary by product.
Anything to look out for?
One important consideration is whether the product offers guaranteed components, and how those compare to what you've contributed.
It's also important to consider the returns, alongside the protection features. Sometimes the benefits go beyond just comparing interest rates with deposits.
But you mentioned that fixed deposit rates will go up and down.
Yes, fixed deposit rates do fluctuate. Some retirement solutions may offer minimum guaranteed components, which can provide more predictable income compared with variable deposit rates.
Good point. Anything else?
Maybe you have to decide if you prefer something that draws down your capital, aka larger payout but leave less for your estate. Or smaller payout and capital is intact and growing for your estate.
Also need to consider if the person prefers the payout to be a certain period, like 10 or 20 years, or they prefer a lifetime payout. Of course, a fixed term payout usually will pay out more than a lifetime payout option.
Options and choices are good.
I would say those are most of the points I would consider. Do you have any other points?
There are quite a few variables to consider when shopping for something that suits us. We must remember, we should always start retirement planning yesterday.
That's all for this episode.